Okay, we are finally live, raw and unfiltered. So let's talk again about the oil market. There's a number of stories that have come out about the oil market in the last week or so, a bunch of interesting stories. You can see one of them on your screen, and this is a big one. So the U.S. shale oil producers, the higher cost oil producers, the deep water offshore guys, this is not going to help them at all. So the oil price right now is at $51.68 a barrel WTI. Brent crude is at $57.05 a barrel. It is the WTI price is having a really hard time staying above $50 a barrel. It is having little rallies on any cerveza related news that is positive about a potential vaccine. But in general, people are looking at the situation in China and seeing that the demand for commodities with factories down, jet planes not flying, people not flying into China, cars not driving, goods not moving back and forth, factories not working. This is not good for energy consumption. So let me talk about this Bloomberg article from Grant Smith from February 13th. Also, I'll talk about a prediction from a hedge fund manager in a minute. The prediction is from Scott Minerd, M-I-N-E-R-D, Global Chief Investment Officer at the Guggenheim Partners Hedge Fund. So I'll talk about that in a little bit. He made a crazy oil prediction. I'm not sure if we get there, but if we do get to his prediction based on how bad he sees the cerveza problem in China and how it's going to last for a while, then he's predicting $25 a barrel oil. And $25 a barrel oil will not be kind to most market participants, suppliers on the supply side in the oil market. Even the low-cost producers will feel enormous amounts of pain. So let me talk about the demand side first with this Bloomberg article from Grant Smith. Global oil demand set to drop for the first time in a decade on the cerveza problem in China. Since I'm going to do my best to not mention that name. Now, I've had six videos now demonetized in the last 10 or 11 days. I will do my best to not mention it, but it's difficult when you're talking for 30, 40, 50 minutes straight without a break and no editing. Okay, so on a live stream show. Global oil demand will drop this quarter for the first time in over a decade as the cerveza problem batters China's economy, the International Energy Agency said. The new estimates show that oil markets face a significant surplus despite the latest production cuts by OPEC and its partners. This surplus, as I've talked about ad nauseum now for months, is because these U.S. shale oil producers are indiscriminately producing oil at basically any price. In order to avoid bankruptcy, they're hoping the price will turn around. A lot of these shale oil producers were smart enough to hedge oil production. A good amount of it increased their hedges at $63 a barrel last month. That has probably bought some of them time, saved some of them from bankruptcy. Okay, back to the article. New estimates show oil markets face significant surplus despite the latest production cuts by OPEC and its partners. Crude already sank to a one-year low below $50 a barrel 2 weeks ago, and the impact of the epidemic will be felt throughout the year, the International Energy Agency said. Quote, demand has been hit hard by the cerveza problem in China and the widespread shutdown of China's economy, the Paris-based International Energy Agency said. It's just ridiculous. I have to self-censor myself, but welcome to dystopia, right? Quote, the crisis is ongoing, and at this stage, it is hard to be precise about the impact. I have to self-censor myself because my Google AdWords revenues have already dropped about 60 or 70% since August and September. So I do have, thankfully, my Patreon account contributors are making sure that my bills get paid and then I can focus on free content like this. But, eventually those might go to, my Google AdWords revenues might go to zero. So then there's not as much incentive to do a free podcast anymore. It sucks, but it is what it is. Hopefully that won't happen. Hopefully, after the cerveza problem is over, then we can get back to I can get back to making money for content like this. Okay, world fuel consumption, which had previously been expected to grow by 800,000 barrels a day during the 3-month period compared with a year earlier, will instead contract by 435,000 barrels a day, the International Energy Agency said in its monthly oil market report. So, oil demand, if you're not familiar with the oil market, oil demand pretty much every year has gone up around, give or take, 1 million barrels per day for many years. And a lot of that, in my opinion, Remember, if you're not familiar with my background, my day job years ago was I worked under Robert Rapier, who is one of the best oil market analysts in the world. He has a $500 a year oil and energy investment newsletter. He has a lot of subscribers to that. And I worked with him. I learned under him. I worked with him for about a year. So I've interviewed him many times over the years. I learned from one of the better people. And one of the main demand drivers for oil has been China for a long time. Basically, since China joined the World Trade Organization about 20 years ago, and by the way, they were never in compliance with many of the WTO rules. There were bribes and payoffs, and people looked the other way so they can get in. But as soon as China joined the World Trade Organization and a lot of the industrial base moved to China, and a lot of investment went to China, and corporations invested there, and China had their version of an emerging middle class, and China started to drive more with infrastructure spending and stuff, the demand for oil and energy in China exploded. Demand for commodities exploded. People in China ate more protein, etc. So the demand driver, why global oil demand was increasing by approximately, give or take, 1 million barrels per day for years, like clockwork for many years now, was China. But this temporarily has gone in reverse. They're estimating contractions of oil demand by 435,000 barrels a day. For 2020 as a whole, the Cerveza problem will curb annual growth in global consumption by about 30% to 825,000 barrels a day, the lowest since 2011. I don't think anyone can give an accurate estimate now. I mean, this is just, I don't know what type of modeling they're using. I don't know what assumptions they're using. We don't know how long the problems are going to last in China. We don't know if the Cerveza problem, how bad it's going to be in the US, how bad it's going to be in Europe. We are seeing the Cerveza problem start to, the amount of people infected with Cerveza, with the Cerveza sickness, Cerveza hangover, start to increase very rapidly in Japan on the cruise ship and in Singapore. But the rest of the world has not gotten hit yet. I suspect that, as I discussed in last night's live stream show, that in the next 2 to 4 weeks, we will know how bad the Cerveza problem is globally. Okay, the effects will be, and again, it's ridiculous I even have to use that phrase instead. The effects will be more significant. I'm going to keep it silly tonight a little joking here. The effects will be more significant than those of the 2003 SARS epidemic because of China's increased importance and integration within the world economy. Outbreak has shuttered businesses and prompted, as I discussed last night, a lot of Chinese businesses are down. Some of the businesses have totally shut down. Some businesses are only running at 10% or less, and Chinese businesses, some of them, there's estimates out there that 80% of private sector Chinese businesses could be out of cash flow in 3 months, which is why you have the People's Bank of China and the banking regulators and others talking about bailouts and loan delays and things like that. Rent reductions. I talked about this on the live stream show last night that has over 8,000 views. Go and listen to it if you have not. I revealed a lot of information that I got from my source trapped inside Wuhan. Okay, the outbreak has shuttered businesses, prompted quarantine of tens of millions of people in China, world's biggest crude importer. The country accounted for about 75% of last year's oil demand growth, according to the International Energy Agency. So China accounted for 75% of last year's oil demand growth. Meanwhile, almost all the oil supply growth, in the globe has come from U.S. shale oil. And Steve St. Angelo did an article recently that I think like 99%, the shale oil bubble accounted for 99% of U.S. oil production growth since 2007. Put that article out last week, February 11th. So I'll attach that in the information and description section if you want to read that. Okay, back to this article, the Bloomberg article earlier this week. U.S. Energy Information Administration, which is another oil data compiler, because you have the International Energy Agency in Paris and then the U.S. one in the Department of Energy at the U.S. Energy Information Administration, also cut its demand outlook due to the Cerveza problem. The EIA lowered its first quarter global petroleum and liquids consumption forecast by 880,000 barrels a day. U.S. crude futures have fallen by more than 17% this year as traders assess the impact of the epidemic. Consumers are unlikely to benefit from the drop in fuel prices because the Cerveza problem will inflict damage on the wider economy. Actually, I've benefited. I just filled up gas, my car with gasoline right after I came home from the gym, and I did benefit. I paid $2 $2.16 a gallon or $2.17. I don't remember it being this cheap in a very, very long time. Okay, OPEC has already done cuts. They're talking about more cuts. Outbreak prompted Saudi Arabia, world's largest oil exporter, to push its allies in the Organization of Petroleum Exporting Countries, or the OPEC cartel, which I guess they don't even like using the word cartel anymore, and beyond, to consider an emergency meeting and further production cuts. However, Russia, the kingdom's most important partner in managing oil supplies, has so far resisted the initiative. Even though the group launched new supply curbs at the start of this year, the slump in demand threatens markets, with a surplus of about 1.7 million barrels a day during the first quarter and 560,000 barrels per day in the second, mostly due to uneconomic U.S. shale oil being produced indiscriminately. I added that part. Last month, OPEC was already, and by the way, if oil prices go lower to the levels that this guy, the hedge fund manager, let me look up his name again, Scott Minard, Global Chief Investment Officer at Guggenheim Partners, he is saying that the cerveza problem in China, the impact of all this on corporate profits and free cash flow will be dramatic. The effect on oil and energy prices could be even more extreme. Right now, he has excess oil production in the world is an estimated 1 million barrels per day. So as demand dries up from repercussions of the cerveza problem, oil could plunge to $25 a barrel unless OPEC or other producers decide to cut production. So if that happens, you're going to see an enormous amount of bankruptcies. And we've already had a lot of bankruptcies already for the first month of 2020. There was an article that came out from the Houston Business Journal. Now it's behind a paywall. I was able to read it last week. I don't know why I can't read it now. I'll put a link in the information and description section. But for the month of January 2020, in Houston alone, there was 55 bankruptcies for businesses just in Houston, and a lot of them, Chapter 7 and Chapter 11, different types of bankruptcy, but a lot of them were energy related. So, crazy stuff. The court recorded 55 Chapter 7 Houston area bankruptcy. I have one paragraph here of the article on another website. Houston area bankruptcy courts recorded 39 business filings, including 13 with total debts above $1 million during the week that ended January 31st, 2020. Year to date through January 31st, 2020, the court recorded 55 Chapter 7 or Chapter 11 business bankruptcy filings, a 450% increase from the same span the prior year. My guess is a lot of that's energy related. Chapter 7, different parts of the energy value chain. So exploration and production, maybe there was some problems with refiners and pipeline companies. Chapter 7 bankruptcy protection typically provides for the liquidation of a business's assets to satisfy creditor claims, while Chapter 11 protection enables a business to restructure. Okay, let me go back to the Bloomberg article. OPEC alliance has... Okay, I remember where I am now. Even though the group launched new supply curbs, so OPEC launched new supply curbs at the start of this year, the slump in... It's what happens when you jump around article to article, but that's how my brain's working right now. The slump in demand threatens markets with a surplus of about 1.7 million barrels a day during the first quarter. So the Guggenheim Partners guy says the surplus is only 1 million barrels per day, and this Bloomberg article says it's 1.7 million barrels per day. That's a big difference. Now remember though, the Permian, the growth, oil production growth in the Permian is slowing. So maybe the hedge fund manager at Guggenheim is accounting for the slowdown in oil production growth at the Permian, because the Permian is slowing down. The production growth at the Permian is slowing. Okay, during the first quarter and 560,000 second last month, OPEC was already pumping the least crude since the financial crisis of 2009. According to the Information Energy Administration, the OPEC Plus alliance had already faced an oversupply in the first half of 2020 because of the ongoing output surge from U.S. shale oil drillers, the agency said. And now you have this unexpected cerveza problem in China, and China is the largest importer of oil. So this is exactly what the oil industry did not need. This is worst case scenario for the oil industry now, because the shale guys are indiscriminately producing. Okay, from U.S. shale oil drillers, the agency said that industry is likely to remain resilient against the price slump until later in the year, predicted. Shale oil industry is likely to remain resilient. I don't think the shale oil companies are going to be as resilient as they claim. Given the abundance of supply, disruptions in OPEC members such as Libya and Nigeria are having little impact on prices, the agency said. Okay, so the oil market, this was mentioned, before I forget, this was mentioned on last week's Macro Voices podcast, and there's a really good interview with volatility hedge fund manager Christopher Cole. Excellent interview. It's very advanced, though. So if you're just a beginner in finance, you're not going to understand what he's talking about with volatility and how he sets up his trades and how he sees markets. But on the show, they talked about the oil market. Eric Townsend did, the co-host of Macro Voices, and his other co-host. And they were talking about the oil futures curve. So this article came out from Reuters News on February 11th. The biggest contango since 2018 could buoy floating oil storage. The cerveza problem in China, the world's biggest oil importer, has triggered a fall more than $10 in Brent crude oil futures. This was last week. The oil market, the articles by Julia Payne and Florence Tan of Reuters News. The oil market this week took a turn that could prompt traders to consider storing oil offshore as a growing crude surplus threatens to worsen. The cerveza problem in China, the world's biggest oil importer, has triggered a fall of more than $10 in Brent crude futures. And this is the type of futures contract LCOC1, as China's state-owned and independent refiners reduce output in the face of tumbling fuel demand. The Brent crude market flipped into contango last week for the first time since July 2019, as prompt prices fell below forward prices. So, for those of you who are wondering, who are beginners, Jason, what is contango? Contango is a situation where the futures price of a commodity is higher than the spot. I'll reread that. I screwed that one up. Contango is a situation where the futures price of a commodity is higher than the spot price. So that means that the spot price is lower than the futures price. So the futures price in the future is higher because there's insurance and storage costs and rolling over the futures contract. There's all these extra costs to hold the futures contract longer before you decide to take delivery and you're betting on a higher oil price. Contango usually occurs when an asset price is expected to rise over time. This results in an upward sloping forward curve. So there are a lot of oil traders that are ignoring the cerveza problem news out of China and elsewhere, and Japan, and the few cases in Europe and Singapore, and whoever knows how many cases here in the US, because I think the mainstream media is not going to report accurately. At least they were probably told not to report accurately at first. So there are oil traders that are betting that the cerveza problems in China are calming down and they're betting on higher oil prices. However, I'm not as bullish. I think in the short term, oil prices could be a lot more pain. Okay, what started as a mild dip, back to this Reuters News article. But what started as a mild dip has powered past $1 per barrel looking further ahead. The 6-month Brent contango spread from April to October and February 2010 widened to around $1.22 a barrel, a level not seen since December 2018. The 6-month spread on West Texas Intermediate on different contracts hit $1. On different futures contracts hit $1. The move has analysts eyeing floating storage opportunities as traders could buy relatively cheap oil now and resell it at a profit later. Quote, the entire forward curve has also shifted into contango now, ING Bank said in a daily research note. Quote, there are reports of increased interest in floating storage as Chinese refiners push for deferred deliveries. Freight rates and storage prices have plummeted as the virus... I didn't say the other name. So as the cerveza problem has hit demand, and since the U.S. partially... Watch this, YouTube will probably do it anyway. And since the U.S. partially lifted sanctions on subsidiaries of Chinese shipping from COSCO. I don't know exactly what that means, but that's not... Well, there's no T in there. I was going to make a joke about Costco. However, physical traders caution that while there are distressed cargoes, long-term storage is not yet a strategy as the Dubai benchmark, which rules Chinese buying, has not followed suit. Quote, some cargoes will have to be floated. No one wants to buy a prompt cargo, said a Singapore-based trader, adding that traders will likely have to take some losses. Right, quote, right now, the market structure cannot cover the cost as February-March Dubai futures contracts dated Brent contracts are still backwardated, which doesn't make any sense. A spokesman for the port of Qingdao said that one of its 2 crude storage facilities still had space. Even though the call on crude in its storage areas has slowed due to the pervasive problem, there is no congestion yet. Further, the organization of OPEC and its allies may deepen, Organization of Petroleum Exporting Countries, or OPEC, and its allies may deepen existing output cuts and thereby erase the contango. Quote, it's a big change, especially after the strong backwardation we had in the Brent curve. To have that large money maker contango, we're not there yet. It's really just the first step, said Olivier Jacob of consultancy Petromatrix. My buddy, Robert Rapier, has an article out in the last couple weeks, about 2.5, 3 weeks ago. Oil bankruptcies are piling up. I'll put that in the information and description section. And last but not least, there's a couple interesting articles from Seeking Alpha about the oil market. One of them that I skimmed through, I didn't read the whole thing, but it was very interesting. This guy, Rita Morwa, about ExxonMobil cannot cover its dividend anymore. And he says it's great news. I don't think it's great news because ExxonMobil has been grossly mismanaged. The amount of capital misallocation, a bad capital allocation by management in ExxonMobil for a long time. There were bad acquisitions done by ExxonMobil of XTO Energy, grossly overpaying, I think, $30 billion at the top of the natural gas market about 10 years ago. It was maybe 2008 or 9. I can't remember the exact date. And then on top of that, if you go back, and this is important, most people don't do this. If you go back and look up all the tens of billions, actually, I think it might be over $100 billion, a lot of the share buybacks that ExxonMobil has done with a combination of free cash flow and debt. ExxonMobil bought back those shares at a much higher stock price than the current stock price right now. So ExxonMobil right now is at $60.65. There were many, many billions of dollars worth of share buybacks done indiscriminately, so people like Rex Tillerson and others could get rich, and the share buybacks were done to boost earnings indiscriminately. The share buybacks, a lot of them, many billions, were done at $80 a share and $90 a share. Let me see if I could pull up ExxonMobil's dividend payout ratio. Let's see here if I can pull it up. Key data, let's see if it's here. I'm on Seeking Alpha. Let me see if I can find it on here. But basically, in this article that I just talked about, ExxonMobil stock is basically flat now since 2005. So if you had bought and held ExxonMobil, you would have collected some dividends, but you had no capital gains. Crazy, huh? ExxonMobil stock price has barely budged since February 24th, 2005. He shows it on the chart. It is a financial engineering disaster. And yet the senior executives, the CEOs of ExxonMobil, paid themselves enormous amounts of money. Oh boy. So ExxonMobil right now has a dividend yield above 5%, almost 6%, which is crazy. But the market cap in the Dow for oil and energy companies has collapsed. So I want to say a decade or two ago, might have been only 10 years ago, the amount of total market cap of all the oil and energy companies was about 20% of the Dow. Guess what it is now? The market cap now of ExxonMobil and all the large oil and energy companies in the Dow is not even 5%. So it's totally collapsed. And that's because a lot of these oil companies, not only are they having problems replacing reserves in oil, especially cheaper economic oil reserves, but also their management teams have focused on financial engineering, and that's to get rich quick. And then they load the balance sheet with debt, and now they're having balance sheet problems too. Let me see, I still couldn't find the dividend payout ratio for ExxonMobil. Wait a second, I think I got it. Oh, here we go. According to Seeking Alpha, which is data provided by S&P Global Market Intelligence, linked into Seeking Alpha, the dividend payout ratio for ExxonMobil is a very unhealthy 111.65%. Not good. Exxon has used financial engineering instead of replacing reserves, doing smart acquisitions when there's blood in the streets, buying more oil reserves. They have done bad acquisitions at the top of markets that they have not written off, and they have done really bad financial engineering with share buybacks with debt and wasted free cash flow. I hope ExxonMobil doesn't need a bailout. But again, I was very cautious about telling people who are long oil because Hedge and Peter Lynch and Jesse Felder, I respect all those guys. Very smart people. I love Peter Lynch. Amazing career investing. Peter Lynch's books are great for beginners to learn. One Up on Wall Street and others. But I was, and this is important, I was looking at the global macro situation. Obviously, I had no idea that the cerveza problem was going to happen in China. But before this, as I've talked about now ad nauseum for the last year or so, the Chinese economy was having really, really bad problems before the cerveza problem. So the cerveza problem has only compounded problems in the Chinese economy. And this is why when you look at the oil market and you see bargains, I was looking at the global macro situation, and I was saying I think oil could go cheaper. Now, eventually, after there's more bankruptcies, there will be really smart, really good bargains for oil. But I don't think we're there yet. So, I was planning on potentially doing, in the next week or two, some type of bonus audio podcast for my Patreon account listeners. Maybe warn people about the companies in the oil market in more detail than on the free podcast here. About the oil companies that are going to have the most problems if oil prices stay at these levels or go lower, and why. And then maybe talk about when oil prices rebound, or if there's literally blood in the streets after lots and lots of bankruptcies, which oil companies will actually be bargains then. So I may actually put that behind the Patreon account paywall for my over 250 patrons in the next week or two. I'll work on something around those lines. I have some interesting ideas that I was thinking about a couple hours ago while I was working out. No, Japan's GDP is not negative. It just fell by 6.3%. It contracted. There was no GDP growth. It contracted. And a lot of it was cerveza problem related to the Chinese economy. Well, I had to think about that for a second, so I didn't say the wrong word. Okay, so I did not plan on a really long show tonight. I think I covered most of the bases that I wanted to cover. And I'll put all these articles that I discussed in the information and description section. But bottom line, I'm not bullish on oil having a big rally until we have proof that the cerveza problems in China are totally dealt with. And I don't trust the Chinese government's numbers, that the amount of people with cerveza hangovers, cerveza infections, cerveza pneumonia, cerveza-related deaths are down. I don't trust the Chinese government for that. And I don't think for at least the next 2 to 4 weeks, we're going to know for sure how bad their cerveza problem is going to be in other countries. West Coast Stacker says he wouldn't trust any government. I agree. Douglas says, I don't trust anybody. I'm not in disagreement. I'm not disagreeing with you on that. Okay, I'll take a look at listener questions and comments, and then I'll wrap this up. Thank you, Justin, for the super chat. Justin, I saw you signed up for my Patreon account, so thank you for joining. I appreciate it. Oh yes, hit the like button. I know I keep forgetting to bring that up. Wow, over 300 people are actually listening to me rant late at night, talking about the oil market. Must be some oil traders here. Mike says, brother, thank you for your service to our country. You're very welcome, Mike. I appreciate it. RR says, what are they going to do if oil goes to $25 a barrel? Well, $25 a barrel would be below the 2008 levels. Because remember, the Chinese did, first of all, the Chinese did 2 enormous buys of oil in the heights of the 2008 financial crisis. They bought way above the market. They bought from Russia and Brazil. Very long-term supply contracts above spot price to help those countries out with oil. So it was win-win for China. And then China also went on an insane amount of QE and stimulus, trillions of dollars. They pumped in a very large portion of their GDP in 2009. And that helped restart the global economy. So I don't know if there's anything like that to restart it. Chinese demand will help. Chinese demand restarting post-Cerveza problem will help the oil market demand again. But there may be a lot of bankruptcies along the way. I don't know if we're going to get down to 25. If we get down to 25, I could see governments collapsing. If we get down to $25 a barrel oil, please tell me how Venezuela is going to survive without the Chinese and Russians like literally giving them tens of billions, hundreds of billions of dollars. I mean, they're propping up Venezuela now for what's left of Venezuela's oil production, but I mean that would basically be the death blow to Venezuela's oil production. You have some of these other oil-producing countries like Libya struggling and some of these others. Venezuela and Libya oil production is down a lot, but that has been offset. That supply declining, oil production declining, has been offset by U.S. shale oil production, which I would argue is subsidized and uneconomic. Pebbleman says he would buy oil futures leveraged at $25 a barrel. I would certainly think about buying oil stocks at $25 a barrel. I would be a buyer there because that would not be sustainable. That would be below almost everyone's production costs. Even the lowest cost producers, even the Saudis would be in some trouble. The Saudis' production costs, my educated guess, is like around $30-35 a barrel. So the Saudis wouldn't go bankrupt. It would hurt their sovereign wealth fund and their government budget deficits and things, and their government budget. Because so much of their government budget is predicated on oil revenue. Oh, I got a super chat. Thank you, Woo-Ali. The Cerveza problem is a good scapegoat to use as an excuse to blame an economic collapse on. If the collapse occurs this year, it makes me wonder. I don't know about that, because let me explain why. I do not think the Chinese would voluntarily kill a bunch of people and collapse their own economy. After all, Xi has said he wants the economy to restart, and the claims of people in China are that China already has a better economy than the U.S. China's going to rule the next 100 years. So I don't think they would voluntarily collapse their own economy. I really don't think China would voluntarily collapse their own economy. I honestly think, my educated guess is that this was a accidental outbreak of a bioweapon. Chinese military, Chinese bureaucrats, they screwed this thing up royally. And now the rest of the world is going to have to clean up this mess. Clean up China's mess. This virus has properties normal viruses don't have. There's a lot of research on this. There's a number of articles about it. People looking at it saying that there's the incubation period, how people are getting infected a second time, stuff like that. There's a lot of things that are not normal about this virus. Like it was the stuff was played with in a lab to make it worse. There's been Indian doctors that have looked and said stuff. There was, I think, an American scientist that said something a couple weeks ago. There was articles about it. Yeah, I don't believe that it occurred at the seafood market or at the pork market. I don't believe that. I don't believe that story. It's kind of, I think what's kind of happened is like obviously Resident Evil is fictional, but it's like how like something got out of the lab. That's my educated guess. I think this was not planned. I think someone got out of one of those two labs and was infected and didn't know it, and then they spread it to their friends, and it just went out of control for 4 to 6 weeks. That's my opinion. Sean says the seafood story has been disproved already. Yeah, I don't believe it. Yeah, RR says it appears from what he's read that it is mutating each time someone gets it again. Yeah, some people have gotten infected twice. They survived the first time, and then it mutated and it got worse and it killed them. I've heard of that from China, cerveza-related deaths. I don't know about timing of this, but I do not think the Chinese would voluntarily do this to their own economy, to their own people, because now the economy is in big, big trouble. The economy could collapse, guys. A lot of these, 80% of Chinese businesses only have 1 to 3 months of cash from the studies that are coming out. That's not me making this up. Those are Chinese universities with studies. That's Tsinghua University I reported, and there's other studies that are saying that a lot of Chinese businesses, over 40 or 50%, have 1 month cash. That means those businesses are going to fire workers and go out of business if this doesn't turn around, if there's not a miracle. That means their economy could implode. Like, not fake 5% GDP growth numbers. We're talking like implosion of their economy. No, I wouldn't short the Shanghai stock market because the People's Bank of China could manipulate it. Why would you want to short the stock market? I think the way, in my opinion, I think this will reflect the problems, pervasive problems in the Chinese economy with commodities, with oil, natural gas, copper, base metals. So far, there has not been manipulation to the upside, a lot of it in those commodities. Maybe that changes, but that's how things look to me right now. Yeah, the People's Bank of China, I think, will prop up the stock market, at least attempt to. I think the reality of the situation in China with the cerveza problem will be in commodities. Okay, well, my voice is definitely starting to go. I want to thank everyone for listening. I have to end this abruptly. My voice is really about to go.